The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Tariffs are back, and you can't say he didn't warn you. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. And maybe they weren't going to be on until March 1st. Now we're back on to February 1st. Confusing?
A little confusing, but lunchtime is over. Let's get to the markets.
All right, let's do it. So you can see some volatility that's really perked up over the last couple hours. We've got conflicting reports as to whether or not we're going to see tariffs on Canada and Mexico. The S&P now flipped into negative territory once the White House confirmed we were going to see tariffs tomorrow, down 0.3%. NASDAQ 100 holding on to gains, but just barely. We were up over 1%. So this is a real decline that we're seeing. The VIX picks up and gold hits yet another record. We got the safety trade. It's sort of a buy dollar, sell bonds, buy gold, Romaine.
Yeah, big cross asset moves on this day. 25% tariffs on Canada, 25 on Mexico, 10 on China. That's what the president says he's going to do. And that was supposed to be priced into markets already. So maybe the price action today is more about the potential for retaliation. Or maybe no one knows, and that's the problem for investors. Big swings today, big volatility, Ford and GM, downward pressure on Boeing and Caterpillar, and a huge sell-off in the ADRs of Chinese and European companies that are reliant on U.S. customers. Mind the moves as well in the apparel sector and clothing retailers. Already reeling this morning from disappointing earnings outlooks from Deckers and Boot Barn. The news flow on tariffs pushing those shares to session lows. The S&P 1500 Textiles and Apparel Index, which was on a 10-day win streak, flipping into the red on day 11 for its worst percentage drop since at least June of last year. All 20 members in that index lower. That includes Nike, Crocs, PVH, and Ralph Lauren. And don't look to big tech to save this market today either. As a group, down for a fourth day in 5 for its worst week since early September. The Philadelphia Semiconductor Index right now, Alex, setting up for its worst week since November.
Yeah, big tech might have at one point round-tripped from earlier in this week, but the semis and the chips cannot catch a break. So here's a way to look at tariffs. These are mentions of tariffs in S&P earnings transcripts. And you can see after the election, the spike that we saw in December and November. In December in transcripts, we were past 200 mentions. We're now at around 32. But was Mexico and Canada really on anyone's bingo card? In the last 11 months of last year, Romaine, U.S. trade with Canada, $699 billion, $776 billion with Mexico. How to replace the stuff that they send to us and what that does to growth and inflation.
Well, we kick you off to the close today with a focus on economics and policy and how tariffs fold into that. Justin Wolfers is professor of economics and public policy at the University of Michigan. And Justin, let's just kind of put this into perspective here. I mean, we've been through these types of tariffs in the past, and quite frankly, those past tariffs are still existing tariffs. What is the impact of slapping a 25 across the board on Mexico, 25 across the board on Canada, and another 10% additional on China?
Roman, you're right to say there's a lot to be learned from the first Trump presidency, where he did impose tariffs. I think what's different here is we've got, first of all, two of our closest trading partners and our geographically close allies. And more to the point, again, the White House hasn't released details, but to the extent that they've said anything, they've been threatening across the board tariffs. So this is not just washing machines. It's not just steel. It's not just aluminium. So it's a much broader swathe of products. It's a much bigger tariff. And so to the extent that the first time around it didn't feel too uncomfortable, I wouldn't get too much comfort from that.
I am curious, though. We had the Treasury Secretary of the United States, Scott Bessent, on Capitol Hill, I believe it was a couple weeks ago, on the 16th. And he was asked specifically about the potential impact of tariffs on the U.S. and the U.S. consumer. And he was kind of dismissive of the idea that, you know, the 10% on China is a 10% pass-through onto the U.S. consumer. And I just want to read you what he had to say, because I am intrigued by this. He makes the case that when you take a look at various elasticities, his words, when you take a look at the appreciation in the dollar, that 10% impact can really be on the ground, maybe a lot less than that, if not zero. Does that make sense?
No. Now let's go back and unpack that. So what affects how expensive imports are to Americans? The price being charged by the company you're importing from, the extra tax or tariff being charged by the American government, and in addition, the exchange rate. And so part of what Bessent's saying is, don't worry, our tariffs won't actually work because the dollar will move to offset part of the impact. It's a very strange defense. It says, to the extent that tariffs are going to do anything, it'll have a smaller effect because of the dollar. It'll have a smaller positive and a smaller negative effect. So whatever the argument is that tariffs are good, you would be upset if the dollar undid some of that. Look, the authors, in fact, that Besant relied on have released an op-ed subsequent to his testimony saying this is a misreading of our research and it shouldn't be relied on in the way that he's relied upon it. So, yeah, it may be that the exchange rate offsets some of the burden of this, but by the same token, expect your avocados to get a whole lot more expensive and your maple syrup too.
Yep, but on the flip side, if my taxes are lower, does that offset those higher avocados and maple syrup?
Wait, whose taxes are lower? I haven't seen a tax plan, have you?
Well, no, but I mean, like, well, if I have more money in my paycheck, will I spend more money on eggs? Syrup.
Wait, who put more money in your paycheck? I'm not getting it.
Well, eventually that's the goal, right? That like the Trump administration is going to help to lower people's taxes.
So this then is a different argument. This is an argument that it's not about the trade deficit, that we're moving from one set of taxes, income taxes, to a different set of taxes, taxes on imports. Fair enough, you might want that. Let's think a little bit about what that does, who that hits. Who imports stuff from Canada and Mexico? The answer is most of us. That's where our fresh fruit and vegetables come from. It's a fairly big share of the spending of middle and working class Americans. Income taxes, of course, really hit those with big incomes. So if we are talking about moving from income taxes to tariffs, what we're talking about is moving from fairly progressive income taxes towards very, very regressive tariffs. And if you take away the spending power of the working and the middle class, I'm not sure you're going to like the consequences.
I am curious, Justin, though, when we talk about the tariffs specifically on Mexico and Canada, I think some of the concern right now in the markets isn't just about the sort of one-for-one relationship that, you know, we buy something from Mexico or they buy something from us. It is that cross-border for U.S. and Canada is truly cross-border. I mean, we take oil from Canada, send it back to the U.S., we do something with it, then send it back to Canada, and then somehow it makes it back to us. Similar story with grains. I mean, we're taking a single product, and that single product in various forms could cross the border 3 or 4 times before it actually gets into a store or a retail outlet here in the U.S. Can this disruption, meaning with Mexico and Canada, be greater than the disruption that we saw when the tariffs were imposed on China 8-10 years ago?
Yes, I think there's a real cost to doing this sort of temporary measure with your nearest neighbours. I'm coming to you from Michigan right now. I'm not far from that Canadian border. A simple car seat might go back and forth across the border half a dozen times. And so, you know, what Trump hopes is that the car seat just stays on the US side of the border and we get all the jobs. A different possibility is the car seat stays on the Canadian side of the border and they get all the jobs. Mm-hmm. But more to the point, this is government taxes sort of disrupting the way that businesses do business. To what end? How are we winning out of this? And then you add on the fact that the Canadians are going to retaliate, and it becomes very hard to see what we gain from this. So one thing your viewers need to understand is a lot of trade is actually within the production of a single good. We're sending things at different stages of production. We do this with China as well, by the way, back and forth and back and forth. That might feel inefficient to you and I if we're thinking about family holidays, but it's actually turns out to be we each specializing in the stuff that we're better at doing.
All right, Justin, I have to leave it there. Always a great conversation. Justin Wolfer is professor of economics and public policy at the University of Michigan. A closer look at those tariffs that Trump promises to impose tomorrow. Stocks right now at a session low. A lot more going on other than just tariffs, including earnings out of a couple of big oil giants. Chevron's downstream business delivering a surprising loss and disappointing Wall Street. A conversation up ahead with the CEO, Mike Wirth.
All right, plus continuing the earnings conversation with the CFO of Aon, looking at shares down slightly after the insurance company beat analyst estimates.
It is the final day of dry January. But one of our guests, well, it's going to be dry all year long. We're going to talk non-alcoholic spirits, and the CEO of a company called Abstinence Spirits discusses the growing trend around this country, Alex Steele, to reduce their booze intake.
I reduce my booze intake.
All that and more coming up in a bit. This is The Close on Bloomberg. It's been quite a week. Remember, we started Monday with that DeepSeek news that led to one of the biggest sell-offs in tech stocks in quite some time. We did get a bit of a rebound in the middle of the week on the back of some relatively encouraging earnings, but now, of course, the threat of tariffs and other policies coming out of Washington knocking stocks down once again. We're going to try to look ahead to next week where maybe the catalysts are going to be a little bit more favorable for markets. Olaolu Aganga joins us right now. She's the Chief Investment Officer at Mercer, and she joins us here in Studio 2. You came into work on Monday, and we all kind of saw these deep-seek headlines, and we saw this big sell-off in tech stocks. And I assume you were probably planning a nice, quiet weekend somewhere away. And now we get the Trump administration making good on that campaign promise to impose tariffs. What has your week been like? Is this basically just clients calling you and saying, what do I do? Do I close out positions? Do I take new positions? Do I just hide under the bed? What?
You've encapsulated the entire week. I mean, we forgot Colombia, right? So we came into the week with news already. So it's been a whirlwind. And I think someone said it best, right? Like, this could be great from a trading environment, right? Like, you need volatility and uncertainty for trading. But for investing, the whole goal is just staying calm, digesting information, waiting for information to be able to react, right?
We did get some information this week on a fundamental level when it came to corporate earnings. I know we still haven't gotten through all of the S&P and all the big companies, but we've got a pretty nice representation so far. How does this earnings season stack up to you so far? Yeah,
I mean, it's consistent, and I'll steal a phrase from Chairman Powell, right? Like, this has been a great patient approach. Right, so they've held steady because all the data has been coming in pretty strong, if we're going to be fair, right? Like, inflation's coming in, the consumer's looking good, earnings have been strong. It's been fairly resilient. So all of this news that's happening all around, the data points are slow and steady. Even the macro data that came out today was like pretty much on the nose, right? So it's keeping out all the noise and just remaining firm. The data's coming in well.
How much do you care about the Fed anymore? In that, she's like, that's not, you can't say that, sacrilegious. If tariffs hinder inflation's progress or disinflation's progress, that's going to affect the Fed. But that's a DC policy and then a trickle down. That's just not straight up Fed policy.
I mean, we could say that's Fed policy, right? But rates up and down is what moved markets the last couple of years. However, they've been very clear in their signaling, right? So patient approach, we stayed steady. We're not in a rush. You notice how they said we're not in a rush to raise rates because they realized that in this environment, tariffs could have an inflationary impact. So moving too soon is not a wise thing to do. We've spent a lot of time trying to get it under control. They've signaled that. So the signaling, I'd be surprised if we moved in the next meeting, but they pretty much told us the patient approach is the way to go.
So what's the best suggestion? Is it diversification? And if that's the case, how much risk do you take on within that diversification?
Yeah, I mean, it's absolutely diversification, right? Like, we've had clients, some of them were like, look, if you look at the U.S. markets, right, like, should we be overweight U.S. equities? On Monday, they called back and said, sorry, let's change our, we changed our minds here. So diversification over the long term is what pays. It eliminates all these swings, right? Like, you need a good mixture of equities, bonds, private markets, right? Like, we still love it. Private credit in this environment is still pretty good. So making sure that you have a number of diversified exposures, hedge fund allocations. We've had them in our portfolios. You've seen double-digit returns in that category just recently. And we've always had a bit of an allocation to each one because at the end of the day, we just can't have really big swings or drawdowns in our portfolio's.
I am curious. I know you're the U.S. Chief Investment Officer, but is there a case for geographic diversification? I mean, you've seen the outperformance this month of European stocks relative to the U.S. And the U.S. had a great month, by the way.
I mean, from a tactical perspective, and we have that too. We have a team that spends their entire day focused on markets and trading and all of that. So from a dynamic asset allocation perspective, you definitely move those things around. We're actually leaning more towards Japan. We've done that for some time. But broadly speaking, from a strategic asset allocation, geographically, it's sort of balanced to the MSCI ACWI world type indices with, occasionally tactical opportunities present themselves.
Are you looking more at broad structural themes, whether it be, AI, infrastructure? I'm not sure what's going on with renewable energy anymore, but these are kind of obviously popular themes coming into this year. Are they still intact?
It's almost like I paid you. We actually have a...
She didn't, I swear.
She didn't, right? We have a report called Themes and Opportunities just for this, right? It's like so you can focus on the structural aspects of things. So AI, security of everything, cybersecurity, how do you protect that, right? Like, you can't get away from AI in tech. Right? It's over 40%, between consumer services and information technology of the U.S. equity market, and that percentage on the world scale, U.S. is much bigger. So yes, themes and opportunities is what we're focused on.
So based on that, normally we'd say AI AI, you'd think chips, you'd think NVIDIA, you'd think the semi index, but that is the part that got hit so hard and could have some issues going forward if DeepSeek is the real deal.
It could, and just a couple hours ago, before the tariff news, they were back up, right? So like the reversal was happening there. So yes, the DeepSeek information that came out earlier signaled that like AI spending, like how much did the U.S. spend versus some of the other areas. But at the same time, if you start looking at the hub of productivity, innovation, all of that, it still comes back to the U.S. So it's very, very possible. We don't know, right? It's very, very possible that there are other areas that could, expand. And this would be good from.
But on AI, you're comfortable with some of the capex numbers that we heard out of these big companies like Meta, like Microsoft. I mean, we're talking run rates now.
Oh no, these
over
are
$10 billion a year.
They're huge numbers, right? But we all know the tech pushes out the curve, right? It's like you spend and then they grow into that, right? So we really have to see, if you bet against tech the last few years, right, it's pretty tough. The innovation is there. The numbers are big. We have to see if it's justified just yet, and really harnessing that productivity.
All right, Olaolu, great stuff. And
Thank you.
I hope you get some rest this weekend. Olaolu Aganga, the U.S. Chief Investment Officer over at Mercer, as we continue to count you down to the closing bell. Stocks off session lows, but red across the screen. When we come back, Part 2 of the Mag 7 earnings continue next week. We're going to give you a preview of some of the big names to keep an eye on, includes Amazon and Alphabet. That's coming up next here on The Close on Bloomberg. Let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start off with Carvana. JP Morgan bumping its price target to 350 from 300. The overweight rating stays. The analyst impressed with the turnaround story, saying the used car retailer is, quote, just getting started on its journey of truly reaping the fruits of its infrastructure. The shares up 1% on the day. Next up, let's take a look at Hershey. Piper Sandler cutting its rating to underweight. The analyst says elevated cocoa costs are sticking around for a little bit longer. And as Hershey's reportedly scrambles to deal with supply pressures, the analyst says that's a worrying sign. Those shares down 1.5%. And finally, Comcast losing its buy rating over at Bank of America. The analyst says 2025 will be a reset year for the cable and media giant as it looks to improve its broadband business. The analyst, though, notes how difficult a task that could be given the 90% penetration of the broadband market. But she says Comcast will likely be leaning more into mobile and converged offerings. Those shares up about 1% on the day, and those are some of our top calls. We do want to turn now to the world of big tech. It was a wild week for big tech, and we're going to get some more earnings next week out of Amazon and Alphabet, among some others. As we speak right now, though, Jensen Huang, the man of the hour, the CEO of NVIDIA, meeting with the president down in Washington at the White House. Mandeep Singh, senior technology analyst over at Bloomberg Intelligence, joins us right now. It's hard to really know where to start with this big week in tech, but we'll start with Jensen Huang because he basically has been the man of the year, man of the last couple of years here. When you look at what happened with DeepSeek at the start of this week and where we are now here at the end of the week, is anything materially changing?
Well, a lot has transpired, not only with DeepSeek, but also OpenAI looking to raise another round at a massive valuation, $350 billion or so. So to me, the Project Stargate, the DeepSeek, all these are sort of contradictory in the sense, like on one hand, everyone is looking to build larger data centers. On the other hand, we are talking about AI efficiency and, costs going down. And NVIDIA is at the center of it all. The former kind of point helps them. Cost coming down doesn't help them.
But this gets into the whole CapEx spend, and we heard from Microsoft, $13 billion run rate on AI spending right now. Of course, Meta has made it clear that they continue to spend at a good clip. We're going to hear from Amazon next week as well as Alphabet. I am curious with regards to Alphabet and the amount of money that they've been spending, how that stacks up with some of these other companies and what you expect to hear on earnings day.
Yeah, so Alphabet is one of those companies that has been using their own chips for training. And now it feels like everyone is fixated on bringing the training cost down. Everyone wants to deploy more AI, so AI inferencing will ramp up because of the lower cost. But training is where everyone is looking for more efficiencies. And Amazon put out a blog, they integrated DeepSeek. Every hyperscaler is integrating DeepSeek, although DeepSeek is being blocked when it comes to the usage at the consumer level. So there are a lot of contradictory trends that are playing out. But I do think when it comes to NVIDIA specifically, you're looking for 2026 and 2027. And no one has the conviction right now to say the CapEx growth will be 40, 50% when it comes to these hyperscalers.
Is it too easy to say that with DeepSeek in the week that we've seen, chips lose, software wins? Is that too easy?
It is too easy, but I think it makes a ton of sense because if inferencing costs are coming down, software vendors benefit the most. And the fear was, LLM costs is coming at the expense of software margins. So right now with LLM costs, inferencing costs going down, software margins should be where they are right now.
So taking that into account, when we look forward to next week, and I appreciate that you don't cover Amazon, but in terms of Amazon Web Services and sort of the cloud provider, based on what we heard from Microsoft, what's your read-through?
I think this helps Amazon because Amazon's biggest problem was they didn't have their own LLM. Microsoft had OpenAI, Google had their Gemini model. Amazon didn't have its own LLM. They were relying on Anthropic. So with more open source, and Amazon is the largest cloud provider. So that's where I think their cloud growth can step up if they have open source options available. So from that perspective, Google Cloud, we know they had a sequential acceleration last quarter. I think they will continue to do well. So this race is getting more competitive. And Microsoft didn't really beat their numbers by a lot. So that's what tells me maybe Amazon could play catch up here in terms of their cloud growth.
I want to ask you something a little bit out of left field. Maybe it's not quite in your wheelhouse, but it is about Meta and a report on the Bloomberg terminal that Meta is seeking to change its incorporation from Delaware to Texas. Now, it does make it clear in this story, based on people familiar, that they're going to keep their corporate headquarters in California. But the changing of these incorporations, we saw this with Tesla, we've seen this, I believe, with Oracle and a few other companies as well. What's the advantage for them to be in Texas, as at least incorporated in Texas, as opposed to being incorporated in Delaware or even having their corporate headquarters in California?
I mean, it looks like right now he's copying Elon with every move. First with the community notes, and now, with the headquarters.
They do that a lot, by the way.
It's so true.
So look, I mean, I think clearly there is a lot of regulatory scrutiny around Meta, both in the U.S. and outside the U.S. And this could be one way to, circumvent that.
So basically, you're going to have Texas be like the energy hub and the hyperscaler hub. Who would have thought that was the case? All right, Mandeep, thanks very much. Mandeep Singh of Bloomberg Intelligence. But it was interesting, if you take a look, Romain, at, say, the S&P and the NASDAQ 100 and the SOX index, over the last 6 days. Today, we did touch that level for the S&P and the NASDAQ 100. We did a round trip. We did not for chips. They were still underperforming. For chips.
And I'm glad you pointed that out, because you're now starting to see that divergence on bets on who wins in this.
Yep, exactly. All right, coming up, a rough day for oil producers like Chevron, reporting a decline in refining profit. We're going to hear from CEO Mike Wirth next. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostic.
And I'm Alex Steele. Taking a look at the worst performing sector in the S&P.
What is that?
Energy.
Energy.
Yep. Chevron, Exxon really leading the decline. Chevron taking a hit after reporting a significant decline in refining profits due to a slump in fuel margins. I had the chance to catch up with Chevron's CEO, Mike Wirth, this morning.
We'd seen capacity tighten around the world. New capacity has been coming in, and supplies with that, and that has kind of steadily stepped margins down, and that was the case last year. We expect that again this year. We've long believed that the middle of this decade we'd be back to mid-cycle margins, and of course, you can get squeezed if feedstock costs go up and refined product prices don't follow. So you have to have facilities that have scale, that have feedstock flexibility, good pull through to your markets. So you've got good value chain economics all the way to the customer, and that's part of the downstream business. And so we've seen these cycles before. We're prepared for them.
Does the cycle get weirder, though, if we get tariffs on Canada and Mexico, say just in terms of the U.S., because the oil price is going to wind up going up, or the heavier crude is going to be harder to get, et cetera?
It could, and it could have more specific impacts. Most of the Canadian crude supply actually comes into the upper Midwest, and so there are certain refineries in that part of the country that are heavily reliant on those supplies. And if those costs go up, or if those supplies were to be redirected to other markets, those refineries get impacted. We tend to be more around the coasts, and so we've got more flexibility because you can bring in product on ships as opposed to by pipeline from Canada. And so last year, less than 10% of our feedstock came from either Mexico or Canada. And so our company wouldn't probably feel it quite the way others would, but it could create some impacts depending upon where your assets are.
But it could hurt in terms of Venezuela if there's any disruption in terms of your ability to operate there, because that's the heavy oil, et cetera. Have you had conversations with the administration on that?
We've had conversations with the prior administrations, both the Biden administration and the first Trump administration. Venezuela's been a subject of discussion for many years. Sanctions have been in place in one form or another over that period of time, and we've worked with both prior administrations on their policy objectives in Venezuela to ensure that we stay in compliance with U.S. law. We'll do that again with this administration, and it's a little early to see exactly what the direction of travel will be on policy there.
Do you have a gut feeling on it that you're going to tell me about right now?
I really don't. It's been a fluid situation, and we try to stay out of the politics between the U.S. and Venezuela, and comply with the law, keep our people safe, keep our operations safe to protect the environment. And that's really our priority.
Okay, let's move to the Permian Basin. Your estimates for production are quite high. You're looking at full year production for this year at about 9 to 10% higher than last year, and you're actually going to be spending less for the first time in years in the Permian. What are the levers that you were able to pull to produce more with less?
The Permian's been a great story. You're well familiar with it. Our production over the last 3 years in the Permian Basin has grown by 300,000 barrels a day. We've been growing over the last 5 years at a 16% compound annual growth rate, and we've seen efficiencies that entire way. And so we're actually delivering the growth we have now with 40% fewer drilling rigs than our plans called for just a few years ago. And so we're finding efficiencies in technology, in process and execution. We're shortening the cycle time on every aspect of what we do, and we're applying technologies to improve recoveries at the same time. And so that's what innovation drives. It's what technology drives. And we're just seeing productivity and efficiency in every aspect of our Permian operations continue to improve. So we can grow production at a lower capital spend, which ultimately creates more free cash flow, which shareholders will enjoy.
When do you think we'll hit sort of peak capital efficiency for the Permian?
It's a great question. We've been anticipating that for some time, and the pace of innovation continues to surprise us, and we continue to find more of these efficiencies. One of the things we're beginning to apply now are certain AI tools that are helping us with well placement, helping us understand the geology even better, help us manage and control fracture placement, et cetera. And so we're seeing advances in lots of technologies, and every time we think we've reached the point at which this productivity will level out, once again we find another way for it to go up. And so it's hard to predict when we reach the end of that cycle. I'm
going to your cost of production. One theory is that President Trump is desperate to lower cost of production for oil producers, so then it is more profitable to produce more oil, and that's where we're going to get this real energy independence. Do you expect President Trump to be able to do that, and where?
As you know, Alex, oil prices are really set in global markets, and they're set by global supply and demand and competition. The U.S. is one supplier, the largest in the world, but still at 13 million barrels a day in a 100 million barrel a day market. There are many other players as well. And so prices will reflect a whole host of factors there. I think the key thing for companies is to be resilient through price cycles. In a commodity business, you always have to be prepared for the downside. We have a very strong balance sheet, a AA credit rating, just 10% net debt. We're seeing rising production and a lowering cost structure and a lower capital spend. And, we've got confidence that the free cash flow over the next 2 years will increase by another $10 billion. Yeah. So we increased our dividend today for the 38th consecutive year, and we're built to win in any price environment.
All right, let's go to hyperscalers and AI. You recently announced Engine One plus GE Vernova to provide natural gas turbines for data centers. You're not a power company, you're an energy company, right? So I'm really interested in the talks that you may be having with large tech hyperscalers.
We've been talking to some of the hyperscalers now for a year or more about their desire to see at-scale power generation to support their data centers. We currently operate nearly 5 gigawatts of power to supply our own facilities around the world. So we've got a lot of experience building and operating large-scale power generation for dedicated customers. Given the increase in power demand and the state of the grid in the U.S., the prospect of building scaled power generation that is off the grid, that can be dedicated to data centers, highly reliable, and brought to market quickly is pretty attractive to these companies. And so we've got 7 of GE Vernova's largest gas turbine generators in the queue for delivery beginning in 26 and on into 27. So we can move with speed. This would be 4 gigawatts of capacity, which is enough to power 3 to 3.5 million homes. So large scale, highly reliable, and something that does fit with our capabilities and our experience. What we've said historically is we didn't see ourselves as a merchant power generator to just generate power to sell into the grid. But we've never ruled out doing something that would be for a high-quality customer with a high-value proposition for reliable power for something like this. And so we're exploring it. We think it can be part of the solution to support AI leadership in this country and leverage America's energy resources.
When you have conversations with the hyperscalers, what's it like to come to a price on these things? Because off-the-grid power could be so valuable. How hard is it to come to those agreements?
Yeah, those are confidential discussions, Alex, but you've seen some reports on things like nuclear and what it may take to recommission nuclear plants that are offline, or what it may take to support construction of new nuclear facilities. And so there are price points that are being established for some of these things. The discussions we've had lead us to believe that we can deliver cost competitive power in a way that also will deliver strong returns for our shareholders. And so we meet customer needs. We also have projects that are competitive within our opportunity set, and that's really what we're driving for.
That was some of my conversation with Mike Wirth, the CEO of Chevron. Romain?
All right, we want to stay in the C-suite now and go from the CEO of Chevron to the CFO of Aon, one of the biggest insurance brokers out there, out with their 4Q results earlier here in the day, slightly above consensus estimates. Brokerage growth, though, trailing competitors just a bit, though we should point out they did have a relatively tough comp from the year over year. Joining us right now is the relatively new CFO, Edmund Reese, Executive Vice President and Chief Financial Officer at Aon. You've only been on the job for about 7 months, but this is all on your shoulders now. I do want to start off with the numbers here. Operating margin did beat consensus, and it looks like some of the guidance you gave, at least on margin improving about 30 basis points, seems like the street was relatively comfortable with that. The numbers that you have out there, you think you can meet those goals?
Yeah, first of all, we had a strong fourth quarter, right? 23% revenue growth, 14% double-digit earnings growth. To cap a pretty strong year. Still top line, organic growth was at 6%, total revenue at 17% and 10% earnings growth. So the first point to me is we're in year one of our 3x3 strategy to help provide solutions to our clients out there, and we had a strong year. As I think about 2025, we have momentum going into 2025, and so you're talking about 80 to 90 basis points of margin expansion. We feel very comfortable with that. We said strong adjusted earnings growth and double-digit free cash flow growth, which is the key metric our investors ask from us. Given the increasing risk, the increasing complexity of those risks and volatility and the impact on our customers, they're looking for more and more of our solutions, and so we feel good.
Well, let's talk about those risks, because they're numerous. I mean, you have a trade war that apparently is just starting. You obviously have a lot of issues around climate change, particularly embodied by what we saw with the Los Angeles fires, cybersecurity, AI. Is there any one thing that has risen to the top of those risks, or is everybody now just kind of across the board?
Well, that's actually a great summary that you just said, because you just hit 3 of the 4 risks that we look at. You named weather, You named trade, you named technology as well with the cyber piece. The other one I'd add to that is workforce, the talent issue that folks are facing. On weather, that was one of the big drivers of our performance in 24 and as we go into 2025. You're, I'm sure, reporting what's happening in California. Catastrophe losses are up to over $360 billion. Only 40% of that is covered by insurance today. So we've been investing $1 billion in our technology, in our data, in our tools to provide our brokers with insights to go help corporations deal with that risk. So that's a big one, Romain. And we can also talk about some of the others.
And just to be clear, just for our viewers, you guys are brokers. So you're not carrying any risk.
We're not the underwriter carrying any risk. Our job is to be able to provide the data and insights to match capital from underwriters and other providers with the corporations that are trying to protect and grow their businesses.
Which takes a lot of the risk out, obviously, as Romain was saying. So how do you help your clients work through some of those risks?
By really investing in the data, in the tools. The unique thing that we do is bring the insights. And maybe just to give you an example, again, one of the topics that I just mentioned here to Romain was the workforce. Health right now is probably just under 20% of the GDP and growing at high single digits a year. We did a survey that showed that employees of companies globally think that two-thirds of them think that they're either going to change jobs or they're in the process of changing jobs today. So companies need to invest. They need to invest in the right health benefits. They need to invest in the right rewards to be able to attract and retain those employees. And we have the data and the insight to help with that as part of our overall broking.
Last year, you completed a $13 billion acquisition of a middle market PC broker, NFP. Is there more in the pipeline? How else do you expand?
Well, first of all, to pause a little bit on NFP, the middle market opportunity is a $31 billion opportunity. And I would say Aon made a great step in acquiring NFP to be able to drive growth in that area. And the integration with NFP and their performance this far is quite strong. Of course, our leverage ratio increased as we made that acquisition. So in the short term, we're focused on bringing that down. But we are also very active in the M&A space, continuing to acquire in the middle market segment as many others do. And I would say in this environment, I would say the M&A activity is increasing, both for us to help our clients who are driving M&A, corporates and PEs that drive M&A, in addition to us making acquisition ourselves.
So you anticipate doing more acquisitions?
Definitely. I mean, on our guidance call today, I talked about creating the free cash flow that allows us to be able to pay down the debt, to pay our debt, but to also continue with our middle market acquisition and return capital to shareholders.
The integration of technology and, more importantly, new technologies like AI internally. How is that helping Aon?
It's helping drive down costs. We're still in early stages, no doubt about it. It's helping drive down costs, but more importantly for us, that $1 billion investment that I just talked about in the data and capabilities. Remember, we are, a leading brokerage, so we have data that not everyone has. So we use that data, AI and now generative AI, to be able to power the capabilities. Our CEO today talked about rolling out a suite of analytical tools. So think things like property analyzers, risk analyzers, cyber, which is increasing in, 3/4 of the companies saying they're increasing that expense. We create the capabilities using AI to help with that risk.
And those analyzers, using them internally, or you're also selling them out to clients?
Well, we of course use them internally as we make our own decisions,
but
it's using it to help clients make decisions about their total cost of risk and how they want to offset that to reduce the volatility in their P&Ls.
Edmund, thanks a lot. It was a real pleasure to have you on set. Please come back. Edmund Reese, Executive Vice President and Chief Financial Officer over at Aon. Let's get a quick check-in here on the markets. We are definitely rolling over here. The Nasdaq is now up by a full 85 points. We're down by about 0.4%, a turnaround from earlier. We saw a rally as much as 1%. Sell-off in the bond market, money going into gold, money going into the dollar as uncertainties abound. We'll take you to the closing bell with Nancy Tengler, CEO and CIO of Laffer Tengler Investments. This is The Close on Bloomberg.
If we are talking about moving from income taxes to tariffs, what we're talking about is moving from fairly progressive income taxes towards very, very regressive tariffs. And if you take away the spending power of the working and the middle class, I'm not sure you're going to like the consequences.
Justin Wolfers, economics and public policy professor at the University of Michigan, kicking us off to the close just about 50 minutes ago. A conversation about tariffs that have pretty much tanked this market. We actually opened higher on the day, but as you take a look at the screen right now, you can see where we're about to end.
Earlier in the day, we erased the losses from this week for the S&P and the NASDAQ 100, and now we can kiss those wins goodbye. You can also see the semi-index, the SOC index, getting hit as well, sort of underperforming on the whole throughout the entire week, and energy gets hit as well. It's so interesting that we still see these downward moves in the equity market on these tariffs news when we know it's coming.
Yeah, absolutely. But, I think that's the idea, is that some people had priced it in, others hadn't, and I think there is some concern about the uncertainty of it all, not so much what we're imposing on Canada and Mexico, but maybe what they do in return.
And also not wanting to take risk then now for the next 24 hours, if we're going to get tariffs or not tomorrow, what it looks like, and will it still be there on Monday?
Yeah, do you hold, if you're a trader, do you hold big positions into a weekend, not really knowing what's going to happen? And you saw what was there up on the board. I mean, some of those numbers on a daily basis might not look like much, but on a weekly basis, some pretty significant declines, 1.6% on the NASDAQ. The SOX down 6% over this 5-day stretch. Nancy Tengler joins us right now to help us count down to the closing bell, CEO and CIO over at Laffer Tengler Investments. And Nancy, we started off this week, of course, with that shock from DeepSeek. Then we got through the middle of the week. We had a Fed meeting that didn't really do much. We had some pretty decent earnings, and now we kind of close it out with more uncertainty around Trump and tariffs. Materially, though, when you look at the fundamentals of the economy, the fundamentals of corporate earnings, are you worried?
No, first, thanks so much for having me. It seems like I'm always on the down days, Romaine. So
that's not intentional, I swear.
Yeah, no, I'm not worried at all. This is reminiscent of Trump 1.0, where we get these massive moves in volatility based on tweets back then. And now we're getting it, based on contradictions over whether or not the tariffs are going to start. I don't know if it matters when they start, if indeed they do start. But if you're using tariffs as a negotiating tactic, and I think he is in for the large part, then you don't want somebody undermining that by saying you didn't really mean it and you're going to delay it for a month. So what you're seeing today are the algos, the hedge funds, the trading side of the market. Investors like me use these kinds of days and the day we got on Monday as opportunities to add to names that we'd like to own on the fundamentals for the long term. And you rightly point out that earnings growth has been pretty robust, and we've seen a fair amount of raises in guidance. And so I think we're on track for 14-15% this year.
So let's go back to that big sell-off then on Monday and all other tech stocks. Did you find buying opportunities there? And if so, anything specific you can share with us?
Yeah, we did. I mean, I didn't believe the numbers. We were short on facts, so I didn't want to get too crazy. But we did add to a couple of the chip names that we own, NVIDIA and Broadcom. We will continue to look for opportunities to do that. We already own Lam Research in a big enough position, but they sort of came out and said, they beat and raised, and that's because they're very optimistic about chip production. I think the general takeaway from DeepSeek was that it was somewhat of a deep fake, and that what we will see is increased spending as Silicon Valley embraces these technologies or this technological advancement and disperses it and deploys it throughout their own models. And last thing I'll say is you're not going to see the enterprise customers jumping into DeepSeek. They're going to continue to work with the secure providers and the robust providers, the hyperscalers.
Hey, Nancy, just we have some breaking news for you. President Trump is speaking in the Oval Office. He's dismissing the idea that tariffs can be averted and says very clearly he will eventually put tariffs on chips, will put tariffs on oil and gas, and will put tariffs on steel. Romaine, this is sort of what we're looking at in terms of trading and volatility. I'm taking a look at the market to gauge where we're going to wind up seeing the reaction. Good.
Yeah, I mean, you see a little bit of a modest dip in the SOX, so that was already down. You're seeing much more of a move right now in oil futures, just kind of dipping into the green here. And it gets to this idea, and I think you asked this earlier, like, wasn't all this supposed to have been priced in already? I mean, we kind of knew this was coming. I mean, he spent months on the campaign trail saying this was coming, and just recently, earlier this week, he was asked about it, and he said, it's coming.
Yep, and he says he'll put tariffs on steel and aluminum this month or next month. So, Nancy, we're talking about chips. I mean, now we're having a totally different kind of conversation from DeepSeek, and now we're back to tariff risks. I understand you're not a trader, but fundamentally, this can affect the future of some of these chip guys. How do you manage that?
Well, I think part of it is going to be offset. I mean, that's the right question, of course, Alex. And we don't know. And we don't know how deep the tariffs are going to be or how broad. I mean, if you go back and look at Trump 1.0, the tariffs on China went up. They went up further under Biden, by the way. But tariffs on other countries went down, like Vietnam and some of our other trading partners. So I think it remains to be seen. But what we do know is that there's an insatiable demand in the U.S. I don't think DeepSeek changes that. And so I think we'll continue to see volume growth, demand growth. We know we have a year's backlog in Blackwell, which is the new NVIDIA chip. So if that melts away, then I think we have a problem. But if it stays pat and we continue to see the spending that we expect, then we think this is going to all work itself out through increased demand in the U.S. and then, of course, through just ongoing demand around the world from sovereign governments and sovereignty. You know what I mean? Yeah. Yes.
Nancy, when you take a look at the sell-off we've seen across the board this week, what else did you buy on sale aside from chips?
We took a stab at a couple of the software names. So I'm not deterred by ServiceNow's announcement that they're going to go to more of a consumption model from a subscription model. That screws up the analysts' models, but it doesn't change the demand and the profitability of the company. So they lowered guidance modestly from 20% to 18.5, 19, but they always beat guidance. So I think that's an area where we added. We also added to some old economy names like Walmart, and we added to, gosh, this always happens to me when I'm on the air.
No, don't worry,
I do
Nancy.
The trades and I can't remember.
Yeah, it happens.
Goldman Sachs, and some of those names. And then Starbucks had a great report. We will be adding to Starbucks across the board.
Really? So you have confidence here that Brian Niccol's going to turn this thing around?
Absolutely, yeah. He said all the right things on the call. Short on China information, but I think that will come next. But they're eliminating SKUs. They're increasing, just what he did at Chipotle. He's increasing delivery time. The condiment bar is back, which I personally love, and I think they're going to continue to drive growth and profitability.
Nancy, you're going to have to leave it there. Nancy Tengler, the CEO and CIO over at Laffer Tengler Investments, helping us count you down to the closing bells. Just about 2 minutes until we get there. Stock's not far off session lows, but a lot of activity elsewhere. The VIX spiking, the dollar back up on more headlines coming out of the White House about tariffs. Trump making it clear he plans to follow through on that pledge. Romaine Bostick here alongside Alex Steele, taking you to the closing bell. And I've got Scarlett Fu on the brain because she joins us right now here in Studio 2. Scarlett.
I love that.
Scarlett
Steele. Kind of the same person, so it makes sense.
Thank you. But Scarlett, in all seriousness, kind of makes sense of this. You were here Monday. Mm-hmm. Then you were here in the middle of the week when things kind of rebounded. And now here we are back in the red, kind of sullying what overall was a relatively decent month for stocks.
It has been a decent month for stocks, but I think it raises a lot of questions about this, whether this run for big tech and AI, whether maybe it has run out of steam a little bit here. DeepSeek definitely changed the narrative and raised a lot of questions. And I know there was a knee-jerk reaction on Monday, and then we all got sidetracked and distracted by the earnings and all the big numbers that these big tech companies reported. But it does raise a lot of questions about going forward, whether we need to rethink a lot of the assumptions.
Did you hear there was a Fed meeting at some point this week?
Oh, gosh, yeah. That was like the back.
Totally missed that. Yeah, 100%. And speaking of, you're looking at a sell-off in the long end, despite sort of the Fed still in a cutting cycle, and that's sort of the fear and the growth scares when it comes to tariffs. Yeah,
and we talk about this idea, too, when we look at the complexion of the market in terms of what moved on a weekly basis, what moved on the month. Big tech was not the leader, once again. And this is, I know some people are saying that's a good thing, but it also is kind of reflective of, I think, some of the fears here about valuations. And the question is, can some of those other names really sustain the moves that we saw over the last few weeks?
Yeah, big tech is the only sector to finish in the red for the month, down about 2.9%. Communication services, worth noting here, that's also encompasses a lot of those big tech names, gained 9.1% for the month as well. But I think we can credit a lot of that to Meta. Everything else did finish higher, so it was a good month overall.
We get the closing bells here in New York, a down day, a down week, and really kind of selling what is still an up month for the major indices. We opened higher and we closed lower with the Dow down more than 300 points, or 0.8%. The S&P 500 lower by about 30 points, or 0.5%. The Nasdaq Composite is going to finish lower by about 54 points, or 0.3%. And let's take a look at the Russell, down about 0.9% on the day. We should point out, with the exception of the Dow, all of the major indices are lower on a weekly basis, but every major indice here in the U.S. is higher on a monthly basis.
That's right. In terms of today's trade, we do see 381 stocks in the S&P 500 declining, 122 finishing higher. So what does that mean in terms of sector performances? There's a lot of red on the screen there. Let's start with the big decliners. Energy stocks losing 2.8%. Alex, I know a lot of this is tied to Chevron and ExxonMobil reporting results, those declines in refining profit. Tech lower by 0.8%. Materials also losing ground by about 0.75%. The two sectors that are in the green right now, communication services up by 0.75%, and consumer discretionary just finishing barely higher by 0.1%.
Yeah, taking a look also at the bond market, guys. I mentioned it earlier. So seeing a sell-off pretty much across the board. In the back end, though, in particular, and I take a look, say, at the 10-year for the whole month, and you're looking at the highest level, or the yields falling the most since the late November. And we're at the lowest there, but now we're rebounding and yields are higher. So how do you price the back end? If you're worried about growth when it comes to tariffs, but we're still supposedly in this cutting cycle, what do you do with that back end?
Well, yeah, and that's a good point. It's kind of interesting, though. I mean, when you look at who benefits from this, I don't know, did you take a look at financial stocks? I mean, they had quite a month, and of course, they are kind of the leaders now. So when we talk about the interplay of rates and the dollar and everything else, there are still pockets that benefit from that. I am curious, though, as to, assuming that Trump follows through on these tariffs tomorrow on February 1st here, are we going to see more of a reaction in the commodity space? I mean, we saw gold at a record high earlier today. A lot of volatility in the oil space, and of course, a lot of action going on right now in soft commodities as people try to game out the system.
I mean, even if it does go into effect on February 1st after midnight tonight, it could be easily taken off before Monday's trade as well. I mean, this is a moving target, right? These are constant negotiations. This is live negotiations, essentially.
Do you remember when we went to war with Colombia?
Right? It was 12 hours.
Yeah.
It was on Sunday. It was like 12
hours, apparently.
But to that point on commodities, it's going to be tricky because it's going to be the differentials, right? There's not one steel price. It's not one aluminum price necessarily. You're going to have different regionals. And it's the same thing with oil, too. If you keep oil landlocked in the U.S. because there's a tariff, that's going to be different.
I am curious, though, too, how this sort of dovetails into the economic picture, right? Because we got a PCE report, which showed inflation relatively in line with what people expected. We had a GDP report earlier this week that showed the economy is still humming along. But then I look at comments from the CEO of CNN Railway saying, okay, you put tariffs on us, we're just passing that through to the consumer. We've heard this from other companies as well. When do we have to start worrying about that?
Yeah, well, the consumer is definitely saying they're exhausted of the price increases they've seen over the last couple of years, and they're definitely concerned about price increases overall. It's keeping them on the back foot when it comes to spending. They are spending, but perhaps not spending the way that they would, that the labor market suggests they would, because of these concerns that prices are going higher.
What we do know, though, is that if you miss on earnings in any way whatsoever, even if you're a consumer name, you will get just taken out by the market. Take a look at Deckers, for example, talking about the consumer. That stock, the worst performing stock within the S&P. They were just talking about those short-term headwinds. They have momentum and growth opportunities, according to analysts, but that short-term issue.
One thing I thought that was interesting in a lot of the earnings that we got this week was how much some of these companies did talk about higher costs. Like, this wasn't so much just a revenue growth slowdown. They're dealing with higher costs. Some of them are dealing with the headwinds from the dollar, obviously labor costs and commodities input costs as well.
Yeah, this is all, it's all adding up to a picture where valuations are, kind of priced to perfection. And we've been hearing about this a lot, especially when it comes to the tech sector. So, any news that comes along that gives people reason to perhaps take some money off the table, certainly what they did on Monday.
Yes, exactly.
And I wonder before we fully understood it.
If we're seeing like individual stock moves to individual volatility really move higher versus, say, the overall VIX, for example.
And we should point out, I mean, we got another busy week next week. I mean, you get another 100+ S&P companies reporting.
The rest of the Mag 7.
Including some big heavyweights. I mean, you at least get, with the exception of NVIDIA, you get Amazon and Alphabet there. And, of course, a lot of other companies that are very consequential to the economy.
Yeah, and I think the same kinds of questions are going to be asked. Everyone's going to be scrutinizing the earnings call for what the executives say about how they're managing costs and how they're positioning themselves in this world of tariffs that may be put on at any time.
AMD Palantir, Merck, Lilly, Match, Mattel, Estee Lauder invest in your face? Are we going to invest in your face?
Yeah. I always invest in my face. But Estee Lauder was really struggling, right? Weren't they looking at strategic opportunities for their business? Because L'Oreal was just eating their lunch to some extent.
Disney,
the streaming, that's going to be interesting, and compare the streaming ads to Netflix.
So.
But in terms of the net ads versus Netflix, like how can you possibly measure up to that?
Yeah, if you're an investor, then how do you sort of make sense of it, or do you do like Olaolu was talking about? The idea is you just kind of try to ignore the noise and focus on those longer-term fundamentals.
Or perhaps it's time for you to look outside of the U.S., right? There has been some movement, a little bit of movement towards European stocks. A lot of people are talking about those emerging markets looking a little bit more attractive.
Oh, it was a big movement. Did you see the outperformance? 6% on European stocks, at least for the benchmark index, relative to 3%
but that
on
would
the
mean
S&P.
you have to lock in your gains in the U.S. and actually move money over. How many people are willing to do that?
Something interesting came up. We were having a conversation a little bit earlier this week, and I kind of forget because we look at the indices on the Bloomberg terminal, and it obviously defaults to dollar. If you change the currency on that to, say, France or Germany, to the local currencies, those 6% gains are like 8, 9, 10% in their local currencies. So they're actually the differentials are much wider for some of those in their local currency relative to ours.
But then what happens if you get tariffs? And then there's tariffs on that, and then all of a sudden Europe
Debbie Downer.
I do.
We're supposed to. I'm told we have to go. Alex.
Bye.
Alex is gone. Scarlet Fu.
And
I got it right
Scarlet
this time.
Steele, Alex
Scarlet
Fu.
Fu is sticking around here. I'm going to continue to break down all of the moves that we had this week, and of course look ahead to what could be another consequential week ahead. Stick with us. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlet Fu.
And I'm Romaine Bostic. If you were looking for a rebound in tech stocks, you didn't necessarily get it. We actually did open higher here on the day, but concerns about tariffs that the President of the United States says that he is going to follow through on. Well, that's a big part of the reason why you're seeing the red on your screen. Only about 1/10% drop on the NASDAQ 100, but on the week down more than 1%. And you saw similar moves with all the other major indices, including the S&P, kind of selling what actually was a relatively good month. In fact, the S&P up about 3% on a month-to-date basis here. But I want to take a look here at what actually moved today. You saw that in the FXI. This is the ETF that tracks some of the large-cap Chinese companies. ADRs and a lot of those Chinese names moved lower on that tariff scare. And in the textile and apparel industry, of course, an industry heavily reliant on imports, we saw them down about 5% on this Friday afternoon. And a lot of movement in the FX space as well, including on the peso and the Canadian dollar.
And it's the tariff concerns that have dragged two ETFs that track Canada and Mexico lower as well. EWC, which tracks Canadian stocks, losing about 1.3%. EWW, which tracks Mexican stocks, losing more than 2%. Chevron was the worst performer in the S&P 500 after the oil major posted a 72% drop in refining profits in 2024. And on the flip side, we've got Franklin Resources trading under the ticker BEN, closing up 10% after saying it's going to cut costs and integrate its Western asset management business, WAMCO, into the parent company after clients pulled $120 billion from the business. Romaine?
All right, we do want to get to the big story of the day, of the week, and that is what's been going on with tech. Right now, we're learning that NVIDIA CEO Jensen Huang did meet with Donald Trump at the White House, concluding a big week for big tech. Sarah Kunst is a big investor in that space, managing director at Cleo Capital, and she joins us now. Sarah, I'm not sure where to start here. You got Jensen Huang, of course, who's been the man of the last couple of years at the White House, I assume making his case for fewer export controls. You have the DeepSeek thing that started off this week showing that maybe potentially China has found a workaround. And in between all that, you had all these tech companies report saying, hey, we're going full speed ahead with this CapEx spending. What do you make of it?
I think that it's been a messy week for AI. What I want to know is, was Jensen already planning to go to the White House, or was that a last minute thing after DeepSeek and then the tariff news? And then obviously, of course, too, did he take him a leather jacket? Because that's the real story here. But, I think that it's just been a chaotic week. I think that the DeepSeek news isn't necessarily terrible for NVIDIA, but it was a great signal to the market that, hey, maybe we should lock in our gains. Maybe, this won't go up forever. And I'm sure that Jensen felt that.
Yeah, and we should point out, according to Bloomberg reporting, this meeting has been in the works for quite some time. So just kind of a coincidence that it ended up on this day. I am curious, though, when you look at the way that the market decided to reevaluate the AI and tech trade. Is there any case to be made that the valuations that just, I don't know, a few days ago, a few weeks ago, we were saying were somewhat justified based on the long-term outlook and the long-term use case for AI, has that fundamentally changed in your view?
I don't think that the fundamentals have changed here. I think that it depends on how you're playing that space. So NVIDIA is still going to be making chips and people are still going to be buying them for a huge range of things, even outside of AI, because that's been a relatively recent driver. They're making chips for crypto, for gaming. They make chips for a lot of things and people are going to buy them. If you're an OpenAI or your Microsoft attached to that stock price, I think that this week was probably a little bit tougher because people are really giving the side eye to that very, very big announcement that they made last week about their CapEx and data centers. And so, yes, it's not necessarily the best time to be saying, as Mark Zuckerberg did yesterday, that, hey, we are putting all the money into AI development. But the reality is, if you like these companies on Monday, not much has changed on Friday.
That's a really good point. Nevertheless, we saw that the announcement of DeepSeek caused investors to really fundamentally question the financials tied to building out AI models. And you've got to think that for Mark Zuckerberg and his cohorts, they're also rethinking a lot of how they spend. Even if they're going to commit $65 billion or $80 billion in Microsoft's case to CapEx, how they deploy that is going to be reconsidered. How do you think that they're shifting that spending?
One, I think when you hear people say that they're committing an insane amount of money to CapEx, what you should know is that hiring will probably be a little bit slower and dividends are going to be much smaller. So I think that what they're signaling directionally to the market will hold. You have to remember, people are ordering a lot of their chips way far in advance. They're making their data center plans really, really far in advance. So these aren't things that are going to change on a dime. And the reality is that smart money has known that a lot of the compute cost in AI will come down over time. This isn't new news to the very smart people around the table at these companies who've been keeping an eye on it. What they're saying, I think, is that they believe that more of their business is going to be tied to compute, is going to be tied to AI. And so they're going to be doing more of it, not necessarily that it will be more expensive.
Got it. As we look ahead to next week, Romain reminded us that you've got two of the Mag 7 names reporting, Alphabet and Amazon. How are investors going to look at Alphabet's results in light of what we've learned from DeepSeek? I mean, Apple is seen as kind of a beneficiary of cheaper, more efficient AI models. Where does Alphabet stand here?
Alphabet is definitely in that same bucket. If you are not directly charging people to access only your AI, it is good for you if the price of AI goes down, because then, you're charging people sort of that one flat fee. I think right now at Alphabet, a lot of it, at least on the consumer and SMB side, is coming out of that sort of $20-ish a month, don't quote me on it, price point for a ton of storage, a ton of other stuff, plus, sort of advanced Gemini. And a lot of Gemini you can access without paying for it on Alphabet. So the reality is that if compute is cheaper, then they are getting you tied to them even cheaper. And that is not bad for them. That being said, I think that they're probably going to see something more like a Meta if they do well in their earnings, where they do well and the market doesn't necessarily reward them for it. And I don't think that that's bad. Not every stock has to go up every day. I know that is not how people feel. But I think the reality is that Alphabet is going to be just fine with compute being cheaper.
Yeah, and I think a lot of companies are. And it kind of gets to this idea, Sarah, that this isn't necessarily a winner takes all. I mean, I know the market likes to kind of look at it like that. And I am wondering, are you finding other opportunities to invest in this space beyond those mega cap names that have dominated the headlines?
Yeah, I mean, I think that so much of the last year and a half has been dominated by Mag 7, and then every Mag 7 company ends up with an AI story. And so it's been all AI all the time. And I don't think that that's necessarily what's actually happening in the market. One of my longtime favorites is Booking. And I think that they're probably in for an interesting year because the stronger dollar dominance and the weaker in some other places mean that we are probably in for a Euro summer to end all Euro summers. And so I think that we're going going to see a lot of booking. We're going to see a lot of travel. Yeah. And I think that will reflect well on that sector. And yeah, that's a sector that can use AI, but it's certainly not a sector that's using that as the only driving force.
I think the Europeans are getting tired of us coming over there.
You think?
The Spanish don't want us there. Portugal saying stay home.
Not just the Europeans, the Japanese as well, anywhere that has a weak currency. Sarah, as we await President Trump to speak, presumably about imposing tariffs on a wide range of imports, does the emergence of DeepSeek this week and the fact that this Chinese startup was able to do so even with the restrictions placed on the most sophisticated semiconductors require us to rethink how we are making our chips available to the rest of the world, particularly China? Do you expect a tightening of the export controls, further export controls on our goods to China?
If I could read Donald Trump's mind, I would probably be the richest woman in the world. I think, though, the reality is that certainly NVIDIA has seen this coming. I think that there's been a huge amount of focus on, hey, these chips really are a huge part of our data sovereignty and part of our tech sovereignty in the U.S. And at the same time, Jensen was over in China very recently having conversations with his companies there. And so the reality is that most of the big chip manufacturers, suppliers, designers are straddling this line with both China and the U.S. And I think that they will continue to straddle it. I think China will continue to pay up and get those chips one way or another. But the reality is there was a lot of hand-wringing over the fact that it was a slightly older model of chip that was used. Mm-hmm. These are still excellent, really good chips that have driven most of the AI development to date. So I think the idea that it's, a 20-year-old Honda compared to a brand new Porsche is just not an accurate description.
All right, good stuff. Sarah, really appreciate your joining us and helping us make sense of this week in tech. Sarah Kunst is Managing Director at Cleo Capital. And of course, as I mentioned, we are still awaiting comments from President Trump, presumably on tariffs. He has said, or the White House has indicated, that they're ready to impose tariffs on Mexico and Canada and China on February 1st. For more on all of this, let's bring in Bloomberg Opinion columnist Jonathan Levin. And Jonathan, I bring you in because you've written several columns about this. And President Trump has said, and repeatedly said, that he does not believe tariffs will cause inflation and will instead bring about this rebirth of U.S. manufacturing, even though economists have pointed out otherwise. You've made the case that when it comes to Trump and how he wants lower interest rates, but also tariffs, he can get lower interest rates if he maybe just pulls back on the tariffs.
Yeah, absolutely. I think if we do tariffs right now, it's going to be one of the biggest macroeconomic own goals in a long, long time. I mean, the situation here is a perfect setup for a president who is predisposed to just sit and allow price trends to play themselves out. We know that base effects are set to be very favorable for the inflation indices in the months ahead. And President Trump could actually be the guy to, roll out the mission accomplished banner, later this year or in 2026 if he would just simply let things play themselves out.
Well, that might be a tall order, given what he campaigned on, Jonathan. But let's talk a little bit about this idea that price trends are already playing themselves out in a certain way. You just look at today's PCE price index, for instance, which is the Fed's favorite inflation metric. It showed a slight pickup on a month-over-month basis, but very much came in exactly as was anticipated. And you look at other indicators like measures of housing prices that later get folded into inflation data, and it shows things are moving in the right direction.
Yeah, that's exactly right. I mean, look, none of us have a crystal ball. There's always some risk that we see some of this excess seasonality in the inflation data, especially in the January numbers. But if that excess seasonality is not too bad, again, those base effects are really going to start to come into play as we get into February, March, April. And we could see those year-on-year numbers dip down into the lower 2%, both on core PCE and on headline PCE. And boy, that could really change the narrative. And I don't understand why a president will want to stand in the way of that.
Is there a case, though, to be made, Jonathan? I'm just playing devil's advocate here, that maybe these tariffs don't have the inflationary impact that some economists have predicted. And I understand classical economic theory, but you listen to Scott Bessent at the Treasury Department during his confirmation hearing, and these are his words, not mine. He basically says, look, you get dollar appreciation. You have other sort of variables out there, elasticities in consumer choice. So maybe 10% on China. The actual effect, net effect, ends up being like 1% or 0.
Yeah, so I heard Justin Wolfers on the program earlier, and I of course agree with what he was saying there, and I agree with you, Romaine, too. But the fact of the matter is the setup here is a lot different from Trump 1.0. Companies have the muscle memory to raise prices on consumers, and so I really think that we have to be extra cautious here, and I just don't understand why we would take the risk. If it's not an inflation impact that prevails here, and perhaps it's actually an economic slowdown that ends up being the bigger effect. In any case, it's not going to be good. So why would you do it?
Yeah, I mean, well, no one knows that answer other than Trump himself. But it gets to this idea, too. And let's take China out of the equation. When we talk about Canada in Mexico, and we're showing the trading that we have with them, at least as a percentage of total trade, there's been a lot of talk about how our relationship with them is much different, particularly with Canada. You know, we take commodities, send them to Canada. They do something with it. They send it back to us. We do something with it, sending back to them. You might have 4 or 5 different cross-border transactions on a single type of product before it gets to the end user. If that's disrupted, what happens?
Yeah, okay, so it ends up being a problem. It ultimately hurts American consumers. And here's something else. If you take energy out of the equation, we're running a surplus with Canada. So what is the excuse for going off after Canada right here? You really come to the conclusion that it is 100% about those other issues, the things that President Trump likes to talk about, namely immigration and drugs. And here's a final point on this, Romaine. You know, if we were to do massive tariffs across the board, the sort of thing that President Trump is talking about, you're going to drive Mexico potentially into a serious slowdown or a recession. What is ultimately going to happen? There's going to be more demand for people to migrate to the United States of America.
Well, hang on. And again, I'm just playing devil's advocate, Jonathan. But but the Trump administration's argument, though, is that this would actually force if not a reshoring, certainly a rethink of how companies or where companies either source their products or make their products. And look, I know realistically you're not going to just set up a new auto plant on the other side of the border overnight, but there are measures that companies can take to sort of deal with this, can they not?
Yeah, there are measures, but here's the thing. You know, the Trump administration already had an opportunity in Trump 1.0 to completely rethink the trade relationship with Canada and Mexico, and they made a lot of noise, just like they're doing right now. And then everybody broke bread, and we came to the table, and we came up with the USMCA, which President Trump himself, you know, hailed as, in his very Donald Trump way, you know, one of the greatest trade deals of all time. I'm probably messing up his exact words. So how do we get to the point where we're 5 years removed from where the USMCA goes in, and it's now the worst situation of all time? It seems very disingenuous to me.
Is there any evidence, Jonathan, that things have changed where there needs to be an adjustment, 5 years later? I'm not saying that there's been a massive sea change, but enough for them to kind of retweak some of the numbers that they had agreed upon.
Yeah, absolutely. I mean, I think very surface level people would look at it and they would say, look, the trade deficit with Mexico has increased since it went in there. And obviously there are some concerns that Chinese goods are being routed through other places, whether it's Vietnam or maybe Mexico, and ending up in the United States and getting around our end goals there. Okay. I totally understand that, but here's the deal. We all made nice in 2020, and we sat down and we agreed that in 2026, we were going to sit down like gentlemen and women and update anything that needed to be updated. Everybody's expecting to do that. So why all the Sturm and Drang here, literally less than a year from when that's supposed to happen?
Well, let's circle this just back to markets, John, and whether the markets can actually deal with this, right? I mean, we kind of know what the president wants to do. He's been telling us this for months now. So can the market find a path forward?
Yeah, I think so. I mean, look, it all depends on what happens here. I think, the peso market, the loonie market, they are telling us, for instance, that that they're not taking these threats very seriously. I have no idea if they are right or wrong. But one thing that we know about markets and American companies is they are extraordinarily resilient. They will adapt. And I feel relatively comfortable sitting here right now. The very worst case scenarios that you hear described are not going to come to pass. But once again, I struggle to understand why, when we have a relatively good situation here, for the next several months, for the next year, why we would stand in the way of that, why we would introduce risks when it feels entirely unnecessary.
Well, you catch them by surprise and maybe you get more concessions as a result because the other side isn't as well prepared. And that kind of speaks to the linkage to markets, which was no one seemed to be prepared for DeepSeek and what it represents, which is a complete rethink of the economics of building out AI models. How do you think about the interplay of tariffs and this idea that AI models could be built out more cheaply happening at the same time, right when valuations are looking very peaky?
Yeah, it's a fascinating story. I don't really know what the interplay is there, but one thing that I'll say about the AI story, extremely potentially bullish for productivity, very complicated in terms of how we should be interpreting this as sort of market observers. I think that the key takeaway here is you have to be extremely humble about saying, I think we may understand what the macro narrative is here, but we really cannot have a high degree of confidence about who necessarily the winners and losers are going to be here. And that, to tie it back to tariffs, may also be true of this policy environment.
Yeah, we're going to stick with tariffs. In conversation right now with Jonathan Levin, a Bloomberg Opinion columnist. He's sticking with us down there in Miami. But let's recap here what's been happening over the last couple of hours. The President of the United States, when repeatedly questioned here about his pledges to impose tariffs on Canada, Mexico, and new tariffs on China on February 1st, tomorrow, he basically made it clear that plans to happen. He said he plans to impose tariffs on a wide range of imports, including steel, aluminum, oil, gas, pharmaceuticals, and semiconductors. Apparently he has been talking at the White House, and we don't actually have that playback yet, but as soon as we get it, we are going to play that for you. We do want to go down to Washington, where Kailey Leinz, the co-host of Balance of Power, is standing by right now. And Kailey, maybe you could put some perspective in this, because we started the day and there were a lot of questions as to whether he was going to make good on that self-imposed February 1st deadline. We heard from his press secretary. She said, oh yeah. And now we're hearing from the president himself.
Yeah, and he just took almost 25 minutes worth of questions from the Oval Office on this and other subjects remain. And he really pushed back on the idea that these tariffs on Canada, Mexico, and China can be averted by tomorrow. He put down that notion pretty much entirely. So it does look, at least for the time being, that those are going to go ahead. And as you alluded to, he suggested a lot more tariffs could be coming in the coming months on a variety of different sectors in goods, pharmaceuticals, drugs and medicines, steel and aluminum tariffs. He suggested that tariffs on chips, oil and gas could happen very soon, put out there as a date, the 18th of February. Romaine, he also said that there would be a lot of tariffs on steel. He suggested steel and aluminum tariffs could come sometime next month. Unclear, given that February 1st is tomorrow, if he's referring to the month of February or perhaps after that. With a lot of these conversations, it's very unclear what the timeline, what the levels we are talking about here. And he went on to say that he absolutely will be putting tariffs on the European Union as well. And just on the idea that there could be negative market reaction to this, the president pushed back on that too. His direct quote was, tariffs don't cause inflation. As we all know, there are plenty of economists who dispute that notion.
Kelly, let's go now down to the White House and listen in.
The American people. Mr. President, is there anything China, Canada, and Mexico can do tonight to forestall your implementation of tariffs tomorrow?
No, nothing. Not right now, no.
Not a negotiating tool?
No, it's not. No, it's a pure economic. We have big deficits with, as you know, with all three of them. And in one case, they're sending massive amounts of fentanyl, killing hundreds of thousands of people a year with the fentanyl. And in the other two cases, they're making it possible for this poison to get in, number one. And number two, we have big deficits, and it's something we're doing, and we'll possibly very substantially increase it. We're not. We'll see how it is, but it's a lot of money coming to the United States. As you know, we have about a $200 billion deficit with Canada, getting close to $200 billion. They've treated us very unfairly. And I say, why should we be subsidizing Canada? It's wonderful. I have so many friends in Canada. It's a great place.
Is there a concession you're looking for, sir?
No, we're not looking for a concession. And we'll just see what happens. We'll see what happens. And with Mexico, it's the same thing. We have a $250 billion deficit, and we have a lot of people coming into the border, and now we've largely stopped that, but we've stopped that ourselves. I think they've done a fantastic job. You've seen the numbers, they've dropped to almost zero. But we've suffered under the past administration for years and years. We've suffered with millions of criminals coming into our country. Criminals, people from jails from all over the world. They come through Mexico, and they come through Canada too. A lot of them come through Canada, and a lot of fentanyl comes through Canada, and China makes the fentanyl. China makes the fentanyl, gives it to Mexico, puts it through Canada, puts it through different places, mostly Mexico, but also a lot through Canada. And so all three haven't treated us very well.
There are significant.
Can I ask you about your meeting with NVIDIA? What did you talk about, and do you think you need to ban more of the chips that they're selling to China?
Well, he's a great gentleman, and I hadn't met him. He's the biggest in the world in terms of chips. And I can't say what's going to happen with it. We had a meeting. It was a good meeting. But eventually we're going to put tariffs on chips. We're going to put tariffs on oil and gas. That'll happen fairly soon. I think around the 18th of February. And we're going to put a lot of tariffs on steel. We already have tariffs on steel, and we've saved our steel industry, but that was relatively small compared to what it'll be. But we're going to be putting tariffs on steel and aluminum and ultimately copper. Copper will take a little bit longer, and that'll happen pretty quickly. It'll mean it'll be a great boost for our steel industry. It'll make our steel industry very strong. If I didn't put the tariffs on years ago on steel, which actually Biden left because there was so much money that they couldn't do anything about it, we would have lost. We wouldn't have one steel mill in this country if I didn't do that. We saved the steel industry. So it was an honor to do it. And I think the people that love me most in the whole world are people that make steel. But we're going to be putting sometime this month, next month, we're going to be putting tariffs on steel and aluminum. And we'll give you an announcement as to what the exact date is. But it'll be a tremendous amount of money for our country, a tremendous amount. These are big numbers. And in addition to that, and you see the power of the tariff. I mean, the tariff is good. And nobody can compete with us because we have by far the biggest piggy bank. And so that'll take place very quickly. But also we'll be doing pharmaceuticals. And to bring our industry back, we want to bring pharmaceuticals back to the country. And the way you bring it back to the country is by putting up a wall, and the wall is a tariff wall. We were the richest country in the world. We were at our richest from 1870 to 1913. That's when we were a tariff country. And then they went to an income tax concept, and how did that work out? It's fine. I mean, it's okay, but would have been very much better. So we'll be doing pharmaceuticals, importantly, and drugs, medicines, etc., all forms of medicine and pharmaceuticals. And we'll be doing, very importantly, steel, and we'll also be doing chips and things associated with chips.
And sir, what do you plan on talking with the Japanese Prime Minister about next Friday when you all meet?
Well, he's coming in, next week. I don't know, he is for a meeting, and I have great respect for Japan. I like Japan. Prime Minister Abe was a very close friend of mine. What happened to him was so sad, one of the saddest days. But they're coming in to speak to me, and I look forward to it.
Mr. President, on the crash, do you have any concerns that your commentary about things you have described as common sense or your observations could in any way interfere with the thorough investigation of the crash?
No, I think they'll do an investigation. It'll probably come out the way I said it. I like to put it up front. I'm so tired of listening to things happen to our country, and then people say, we'll do an investigation, and 3 years later they come out with a report that nobody looks at. Especially, not in all cases can you do that, but in this case, you had a helicopter that was, the Black Hawk was too high. It was above the 200 limit by double. shouldn't have been there. And there were some other.
And we're listening to the President of the United States, Donald Trump. We should point out this is tape playback. He was speaking a little while ago. We're now getting the video footage of that from the Oval Office, answering a wide range of questions, including about tariffs, which, of course, is the big story of the day that actually moved markets. We should point out for our viewers, you can go to Live Go to continue to hear the rest of those comments. But, Scarlett, we should point out most of those comments were already out. We had them across the Bloomberg terminal, and we know the contours. Tariffs are coming, and apparently they're going to start tomorrow.
And they're going to start tomorrow. The tariffs on oil and gas may come on February 18th. And when asked whether there could be any kind of thing to avert these tariffs, the president dismissed that and said that they're coming. He's not looking for any kind of negotiations at this point. They're going to happen.
And of course, also the volatility associated with that. Some further comments saying that, well, maybe they could go down in a while. And this is exactly what the market has been reacting to. Stick with us. We have a lot more coverage coming up here on The Big Show. This is Bloomberg.
It's time now for Next Up, where we highlight the entrepreneurs and trendsetters moving the needle. And on this final day of January, and dry January at that, we look back to how the month kicked off with the outgoing U.S. Surgeon General Vivek Murthy announcing a link between alcohol consumption and 7 types of cancer. Now, he delivered this message at a time when Americans' opinions about alcohol are shifting. And one example of a company positioned to capitalize on this shift is Abstinence Spirits, whose January sales rose 2 to 3 times their 2024 peak. Ranwei Chiang is CEO of Abstinence Spirits, and she joins us now. Ranwei, good to speak with you. Dry January has been a thing for a while now, for more than a decade. But this year you had the added stimulus, I guess, of Vivek Murthy's warning supporting the idea that abstaining from alcohol is better for your health. Have you seen any quantifiable impact this month from that warning?
Yeah, we've actually seen our top selling SKU, our Blood Orange Aperitif, is actually 2 to 3 times our volume from even the holiday season in December. So we've seen a huge growth in our sales and a big bump in our sales and revenue in January. And so we're excited to see how that translates as people transition out of dry January into the rest of the year. And so hopefully we'll see that continue to grow.
So what typically happens once you get past dry January? I mean, yes, the idea is that you build on the momentum you got in January, but I would imagine there's kind of a drop off into February, and certainly as you get closer to warmer weather in the Northern Hemisphere, it drops off even further.
Yeah, so what we see every year is a lift for dry January, and then we see a new normal in terms of sales trends for the year. So every year we kind of see a big bump, and it does carry through, even though January is the highest month. And so, I mean, last year, sales in non-alcoholic spirits in general and the whole category were up 27%. And so we're excited that we're seeing our piece of that pie grow.
And it's kind of interesting to see how this took hold. I mean, this became popular in our household, not necessarily your brands, but similar non-alcoholic brands. And I am curious about the process of how you're making it and what the intent is. Are you trying to create spirits that replicate the taste of alcoholic drinks, or are you just trying to create completely different flavor profiles altogether?
Yeah, we kind of bridge the middle of that gap. And so we have spirits that are kind of analog to a normal spirit, like a spiced rum or a gin or a whiskey. But because there's no alcohol in it, we want to take the best flavor profiles and blends and make sure that we're creating products that are really exciting and flavorful and sophisticated that people want to drink. So we're taking the same like artisanal craft distillation process, but applying it to our non-alcoholic products.
And so who are you going for here? Are you going for those folks who maybe are hard drinkers that maybe want to reduce their booze intake, or maybe people that never drank at all, or maybe people that are going to continue to drink but see this as maybe just, almost like the equivalent of a soft drink, for lack of a better term?
Yeah, so we're kind of going after that person who's trying to moderate and change their drinking habits. So 93% of people who buy non-alcoholic products also buy alcohol. So we're really, rather than seeing people who are abstaining in total, we have people who are, making moderation choices or are taking on more mindful drinking habits. And so we're really there for those consumers and have a product that's beautiful to mix. You can still make cocktails, have that same mixology program at a bar or restaurant, and you can plug in our Abstinence Spirits with that. And so we're really looking at those drinkers who still want alcoholic or, adult flavors even when they're not drinking.
All right, Ranwei Chiang, CEO of Abstinence Spirits, and of course you can buy that stuff, shake them up at home, or maybe you go out to a bar and have a real bartender shake it up for you. A new study out there finding that younger generations are consuming less alcohol, but you know what? They still want to go out. There's a new bar out in Brooklyn, New York called Mockingbird. It's a zero-proof cocktail bar, and I'm pleased to say we're joined now by one of the founders, Coulton Vento. Great to have you, Coulton.
Hi, thanks.
So I have not had a chance to go there. So, like I said, we kind of got into the non-alcoholic spirits at home because we, both me and my wife had some health issues, and we've really taken to it. But I can't say we've really gone out to a dedicated non-alcoholic bar of any kind. Do you see a real market for this?
I do. Our bread and butter is creative non-alcoholic cocktails, and I gave up alcohol about a year ago during Dry January, and I was just disappointed with the options. So I and my business partner and I opened Mockingbird about 2 weeks ago. And we really wanted to create innovative, creative cocktails with an experience that you can't find anywhere else.
And I'm going through the menu of what you had, at least what you have on the website, because you go back a few years, and if you were going to a regular bar or restaurant and you wanted a non-alcoholic drink, even if a lot of them didn't even have anything on the menu, or if they did, it was basically just some juice and a spritz of a
Shirley Temple, right?
Right, but I mean the Vermilion spritz, doctor's orders, antidote deep red, lemon lime, egg white, raspberry cream. I mean these are cocktails basically, but without the alcohol.
Exactly. So if you look through our menu, each cocktail is creative in its own way. So you talked about the Vermilion spritz. That a typical spritz cocktail would be, an aperitif as well as sparkling wine, but we don't use sparkling wine. We use verjus, and we carbonate the cocktail directly with CO2. Okay. So it's a show as well as a very delicious drink and very elevated adult-only space.
Yeah. Well, presentation matters, right?
It does. Yes.
Talk about the pricing, because when I go to a bar and I look at the mocktail list, the pricing is sometimes it's often the same, if not higher, than the alcoholic drinks, which always kind of catches me by surprise. I don't want to be paying that much for essentially sugar.
Right.
What is the pricing component here for these non-alcoholic drinks? Why are they often higher than alcoholic drinks?
Well, it's the base spirit, like we talked with abstinence. It's these non-alcoholic spirits. They take time, and sometimes they take additional steps to create the product. And they're also using, the same unique spice blends that liqueurs use, like gentian and other bittering agents. So of course they're going to cost just as much. And a lot of these brands are a lot smaller, so they don't have access to certain resources that larger distilleries or breweries will have. So we price our drinks accordingly, and we've only been open 2 weeks, but people are willing to pay.
People are willing to pay, but I wonder, as more companies enter this space, like Abstinence Spirits, for instance, do you see prices going down as competition increases?
I could, yeah. The increase in popularity I can definitely see that.
So when we talk about how much a business like this can grow, I know, obviously you sell a lot more than just, these mocktails.
Yes,
you have food, you have a full menu there. So I know you have other streams of revenue. But can this be scaled up, I guess, if you will? And I'm talking about not necessarily just selling stuff in prepackaged form like our previous guest, but having these types of actual experiences.
Yes, for sure. We have looked into hosting events. We have looked into non-alcoholic catering. We've seen a lot of interest in that segment. You don't want to, you want to have a wedding, but you don't, want to drink for specific reasons.
Corporate events
now. Corporate events
a lot of
too,
corporate events, they don't want to have alcohol anymore, but you still want something fun.
Exactly.
I do.
Yeah.
So we wanted to start with the bar itself and then expand in the future. So
you weren't a bartender, were you?
No, I wasn't.
You were like an
no.
app developer or something.
Yes.
Okay.
I've been
This
working
is a pretty
in tech.
big swing.
It is, yeah. I mean, I've been into cocktails since I was basically 21.
Yeah.
And
which means before 21. I get it. You're serious.
And when I gave up alcohol, I was like really disappointed. Like, will I ever have another cocktail? I kind of discovered the world of non-alc, here I am now.
A lot of people go to non-alcohol spirits and drinks out of curiosity. What's the thing that pulls them back to the alcoholic drinks? Is there any one thing that the non-alcoholic drinks profile just can't replicate?
I honestly think it's just availability and how alcohol is everywhere and ingrained in people's minds. So that's just my opinion, but I think availability is number one.
All right, interesting. I would have thought like the buzz or something. They actively seek that buzz.
Potentially, yes.
Coulton Vento, really appreciate you joining us today.
Thank
Coulton
you.
Vento is founder of Mockingbird in Brooklyn, Park Slope, Brooklyn, right?
Yes.
All right.
And of course, this is the final day of dry January, but like our last two guests were saying, of course, this is a trend that goes forward through the rest of the year for a lot of folks. A lot of folks really concerned about their health and really trying to take advantage of it at the start of the new year. And that actually helps out other companies as well in the wellness space, including companies like Press Juicery. They're hoping to expand from a word-of-mouth brand to a global household name. We had a chance to catch up with the CEO, talk about its origins and product offerings at national retailers.
It's pretty wild to see the kind of transition of the business from a local truck and really a 100 square foot, a small little hole in the wall retail store in Brentwood to where we're at today with over 100 locations. But the business started as a typical entrepreneurial endeavor and got it quite large. And I've come in to obviously see if we can continue to expand it as kind of a personal health and wellness advocate and consumer of the product. And I've been watching the brand my whole career, so I was really excited to be able to kind of come in and see if we can kind of amplify what's already happening in our 100 stores.
100 stores. How many stores would you like to get to under your leadership?
So what we've decided is with our footprint of 100 locations from New York City to Texas to West LA up into Seattle, that's a phenomenal footprint. We've done almost $700 million of sales since company inception. And really, for us to kind of amplify and accelerate this brand, it's faster and frankly, probably the right time to go into wholesale. So we're currently not adding stores. We're just really improving everything from operations, expanding offerings, doubling down on our kind of protein-infused wellness bowls and acai bowls and dairy-free frozen yogurt we call Freeze, and then experimenting with different add-ons, supplements, and other kind of health-focused products in our stores. But our juice is our main driver, and we intend to kind of take that more into wholesale, then add stores over the next couple of years. Frankly, it's the ability to get into a lot more mouths faster and into more doors in a faster way.
So when you talk about wholesale, I mean, what is the retail outlet where I will be able to find this? Are we talking grocery stores? Are we talking restaurants? What?
So currently the vision that I have is if you wake up in the morning to the time you go to bed, at some point in your journey, we want you to be exposed to Press Juicery, whether it's our shots, our famous green juices, amongst other SKUs that we're launching. So we have a big focus on food service and grab and go, especially more elevated retail establishments, such as like a Blue Bottle Coffee, where we're currently sold and doing really well, to niche hotels all over the country, get our product and want it in their fridges. And we actually have a program to be able to service that in really unique, I would say, upscale and distant offerings as far as, Montana, I've seen it and want it. And then we're working with the natural channel, which is the grocery channel, and most recently Target and Costco on a very select basis offering our SKUs there too. So we're looking at fitness and gyms and college universities, anywhere where people are focused on wellness and looking for alternatives to kind of more traditional drinks. And because we're cold chain, we have to be really mindful of our expansion strategy.
How do you keep track of not only, of course, the freshness of your product, but more importantly, what people want, right? Because you don't want to ship, too many, beet juices here or too many acai bowls there. How do you keep track of that? Do you have that sort of system in place now?
Yeah, so we're vertically integrated. We manufacture everything ourselves in Central California. and distribute to our 100 stores across the country, as well as retail partners and wholesale partners throughout the country. Because we're at the tip of the spear in our stores in terms of folks focused on wellness and better for you beverages, gives us a good sense of what people want, what's trending, obviously what we're promoting, and we're kind of leveraging this knowledge and insight we're getting from our stores, because we're one of the only really beverage or any food retailer in the country that can do this. And how do we transfer that knowledge in a pretty efficient and swift way into our kind of wholesale national partners?
What about the marketing side of this? I think for a lot of folks, including myself, I became aware of press through social media, and it seems like at one point you guys were very prolific in making sure that your name got out. Is that still the core part of your marketing strategy?
It's interesting. So our brick and mortar four-wall retail has a very localized guerrilla marketing strategy to get into the community, and then there's a big digital ecosystem that we rely on a lot of content from our users. Wellness is not a trend, right? It's here to stay, and we've been doing it for a long time. So we have really, really amazing, I would call brand ambassadors and users of our product that are self-generating content, whether it's on TikTok or Instagram or other platforms. We obviously try to amplify that sometimes on our own, but a lot of it is organic and then very intentional. The brand is bigger than any one individual kind of media person that we might partner with. So a lot of the amazing success we've seen is our actual guests that come into our stores posting about their journey, and we call it really their wellness journey, where they're at on it, whether it's starting it with a cleanse or maybe amplifying it with our new protein. So it's a really interesting strategy. But yeah, we do spend on the social channels, but the organic content for us is really the most powerful.
Conversation that we had with the CEO and the co-founder of Press Juicery, Justin Nedelman here. Are you on a wellness journey, Scarlett Fu?
I should be, but I'm not. I mean, maybe I'll start in February.
Yeah, I mean, I feel like at the start of every year, everyone does this. You do the juice detoxes. Maybe you do dry January. The question is, does that actually, last into February? But look, as far as the dry stuff, the non-alcoholic stuff. I mean, we use that a lot in our household. I haven't been to an actual bar that does this, but I am intrigued by it.
Yeah, no, it definitely sounds intriguing, but I want the price point to come down. I mean, seriously, when mocktails are $15, $16, I might as well get buzzed.
All right, well said. You can just add a little nip into there on your own if you want to. Anyway, it's been an incredibly busy week for financial markets. Next week promises to be just as busy. Let's set you up here for what to watch over the next week. And we start off on Monday with some economic data, those global PMIs. Yeah, read on the global economy, and by all accounts, it remains the same story, which is the U.S. is doing fine. The rest of the world is slowing down. There is going to be Fed speak as well from Raphael Bostic, but he's no longer a voting member of the FOMC. Earnings are going to be much more in focus. Palantir and Tyson Foods on Monday, and then you flip to Tuesday, and you get some big names there, including Alphabet and AMD. Yeah, and those are the ones we're really going to be watching. Sarah Kunst of Cleo Capital was just telling us that Alphabet should be a beneficiary of the cheaper AI model coming out of DeepSeek. So we'll see what kind of comments they come out with. Spotify and Snap will also be reporting. What do you think about PepsiCo? They're supposed to report, and I know there's been a big talk now about tariffs and commodity costs, and I wonder how a company like PepsiCo, which of course not only has the beverages but the snack brands, how they might fare in this new environment. Yeah, and perhaps how they're faring with people moving to a more health-conscious effort. Remember, they were trying to do that for a while, too. On Wednesday, we're going to get earnings out of Ford, Uber, Qualcomm, Novo Nordisk, and Disney. And Disney, yeah. And Disney, of course, kind of sets the tone for the rest of the streamers as well after its Disney Plus streaming business turned profitable last quarter. And then you turn to Thursday. I mean, speaking of streaming, speaking of the cloud, Amazon. I mean, are they going to disappoint? Are they going to lift this market? What do you expect? Amazon kind of, they manage their earnings pretty carefully. So I'm expecting that they're going to have some good news to deliver, as they always do. And we have a Bank of England rate decision as well. And then on Friday, it ain't over, folks. You know what? The jobs report, monthly jobs report, Scarlett, it never stops. It never stops. The January jobs report comes out 8:30 a.m. and University of Michigan consumer sentiment. What investors think about inflation going forward? We really appreciate you joining us here on The Close this week. We'll have all your market moving coverage next week, right here on Bloomberg.